Welcome back to the Market Insights. Today we're looking at U.S. stock futures as of January 15th, pre-market, which show a mildly positive bias, particularly in the tech sector. This follows Wall Street's first back-to-back losing sessions of the year. Rachel, what's the immediate picture this morning?
Good morning, Jake. We're seeing a slight uptick across the board, attempting a rebound. S&P 500 futures are up around 0.4%, and the Nasdaq 100 futures are leading with gains closer to 0.9%. The Dow Jones Industrial Average futures, however, are slightly flatter, showing a minor drop of about 0.1%. The implied open suggests a recovery, largely driven by semiconductors and AI-related stocks after some recent tech weakness.
So tech is definitely leading the charge. What are the key drivers behind this attempted recovery, especially after those recent losses?
Primary driver is the stunningly strong earnings report from Taiwan Semiconductor Manufacturing Company, or TSMC. They reported a massive 35% jump in Q4 profit, significantly boosted by AI demand. Crucially, they also announced plans for $56 billion in investments for 2026, signaling sustained big tech spending on AI infrastructure. This has lifted chip stocks and Nasdaq futures, with key suppliers like ASML even hitting record highs, crossing over $500 billion market cap.
That's a significant boost. It seems TSMC's outlook is overriding some of the other concerns we've seen in the chip sector, like earlier reports on NVIDIA's H200 chip export limits to China. Are there any other factors contributing to this rebound attempt?
Absolutely. This rebound is also a direct reaction to the market's first consecutive declines this year. Major indexes fell on January 14th, with the S&P down 0.5% and the Nasdaq down 1%. Futures reflect what appears to be some bargain hunting and strategic positioning for recovery, particularly in these growth sectors. On the broader macro front, we don't have any major U.S. data releases like CPI or jobs reports scheduled for today, so the focus remains squarely on corporate outlooks and global AI tailwinds.
That lack of macro catalysts could mean more attention on individual company news. I also noticed reports of an oil pullback. How is that influencing the market today?
Oil pullback is certainly supportive. Brent and WTI crude are both down nearly 3% this morning. This eases some inflation fears we had priced in and provides a marginal benefit to equities, as lower energy costs can reduce overall business expenses and ease consumer burdens.
So with these factors in play, how would you characterize the overall market sentiment going into the trading day?
Overall, we're seeing a neutral to bullish tilt in pre-market action. There's clear bullish momentum in tech and AI, coupled with what looks like institutional buying into these dips after the recent pullback. The VIX is holding steady around 15, which indicates moderate volatility expectations, not panic. While there's significant retail buzz on AI and chips, there's also lingering caution regarding sustained Fed risks and those ongoing export curbs. But generally, analyst consensus favors a tech recovery today.
Given all this, what stocks or sectors should listeners be watching closely today?
Certainly, NVIDIA and its closest chip peers like TSM and ASML are definitely top of the watch list. Validation of AI demand could drive further gains there. Broadcom and AMD also stand to benefit significantly from the TSMC spillover effect. We should also keep an eye on broader tech heavyweights such as Apple and Microsoft for potential sympathy moves if the Nasdaq truly leads this recovery. The energy sector will be important to watch for reactions to oil price movements, and interestingly, Boeing has been noted by some analysts as a top pick heading into 2026, signaling potential broader industrial strength outside of pure tech.
Excellent insights, Rachel, and as always, a reminder that these are pre-market indications and futures can shift rapidly. Thank you for breaking down the market landscape today.